Hey everyone, happy Saturday again. Charlie here, bringing you an update on 003 from the OCC. This was approved on Thursday of last week, and this is the order approving proposed rule change to establish OCC's persistent minimum skin in the game. This video is for those of you who still are a little confused by this, and I'm going to break it down in a little bit more detail and hopefully clear up any confusion. So real quick, the timeline surrounding this, we did have an advance notice, OCC 801, that was filed, and we also had 003, which was first filed on February 10th. It was published for public comment in the Fed Register on March 2nd, and then it was approved as of May 27th last week. So a couple of terms to define real quick. Skin in the game, what that means, it entails a covered clearing agency upon the occurrence of a default or series of defaults to apply its own capital contribution to the relevant clearing or guarantee fund in full to satisfy any remaining losses. Now also, EDCP unvested balance is just the executive deferred compensation plan, and what that is it gives the employer a way of putting off a guaranteed supplemental amount of the executive's earnings for a later date, normally after retirement. So they're going to be dipping into this EDCP unvested balance if needed to gather the skin in the game. So the changes surrounding this, so OCC's current setup do not dedicate OCC's excess capital for use solely as skin in the game, or guarantee that OCC maintain a minimum amount of skin in the game. So OCC proposes to establish a persistent minimum level of skin in the game that OCC would contribute to cover default losses or liquidity shortfalls. And such skin in the game would consist of a minimum amount of OCC's own pre-funded resources that OCC would contribute prior to charging a loss to the clearing fund and the EDCP unvested balance. Requires a minimum level of OCC's own funds maintained exclusively to cover credit losses or liquidity shortfalls. Now, while that's mainly it surrounding the filing, there is an interesting comment that leads me to believe that this is far more relevant to our current situation in AMC and GameStop than we all think. So there was a comment submitted by Susquehanna International Group, which we all know was heavily involved in GameStop back in January. Just as a quick recap here, on March 31st, they filed a 13F HR, pretty much letting us know that the value of their position and the shares of their position went down quite a bit. And as of today, they filed an HFR on the 17th, and they disclosed an ownership of 146,000 shares of GameStop with a total holdings valued at $27 million. So yeah, the big player here, they did not like the passage of this rule. I'm going to go ahead and break down the comment itself on the next few slides. As far as call and put options, they currently hold 3,454,400 call options, valued at $671,000. I'm sorry, $671 million. And then they have 6,151,100 put options, valued at $1,196,143. So yes, big player. This information is as of May 17th, 2021. So taking a look at the comment they submitted, this is straight out of the filing. It says right here, in its comment letter, SIG, which is Susquehanna International Group, argues that the proposed rule change contravenes the protection of investors and the public interest. 29 SIG states that OCC was established as a monopoly organization in order to serve a market utility, and that it has always been recognized and accepted by concerned parties that monies held as excess OCC capital are excess fees not yet rebated, as opposed to retained earnings. So they're pretty much arguing that by doing this rule, the investors, such as you and I, are going to be the ones contributing the fees, not members of the OCC. So in support of its argument that OCC should not retain earnings generated through clearing fees, Susquehanna stated that OCC has not previously had to draw on such funds to address a shortfall. Yeah, no, duh. That's why they're doing it. So, and then the commission came back with, the commission is not persuaded by SIG's arguments with regard to section 17A, subsection B3F. As discussed above, the commission believes that holding a defined minimum corporate contribution would incentivize OCC further to maintain the appropriate amount of resources to manage a clearing member default. So obviously very concerned about defaulting members here. It goes on to say that Susquehanna argues further that OCC's proposal puts only the public skin in the game. Susquehanna states that market participants bear the risk and prudent decisions by the exchanges in their capacity as the OCC shareholders and of their designee board members, because such participants would be denied a rebate of excess fees. Whoop-de-doo. The Commission is not persuaded by this argument either. SIG's argument assumes that OCC's clearing members have a right to clearing fee revenues not applied to operating costs in a given year. But, as noted above in this section, OCC's rules, as approved by the Commission, do not require OCC to distribute retained earnings in excess of expenses. So, in essence, what does this all mean? It means we have a big player that we know that's in GameStop that is not happy with this filing. Regardless, it got passed anyway. And then the overall summary, OCC proposes to set aside a defined amount of capital for the sole purpose of absorbing losses and shortfalls. Man, that's been a recurring theme in this filing. Losses and shortfalls arising out of a clearing member default. Hope you found this helpful. If you have any more questions, let me know below. And you'll have a good weekend.